Stocks may be at lofty levels, but we're going to talk bonds now, specifically municipal bonds. It's part of our week-long series on key investment strategies. Last year, Detroit's bankruptcy protection filing and pension worries in Illinois scared investors, and the Muni bond market posted its worst year in almost 2 decades. This year, however, Munis are making a comeback, and that's why we're going to tell you all about them right now. I asked financial advisor Doug Flynn, co-founder of Flynn Zito Capital Management, to help us out. He started by telling us exactly what a municipal bond is.
It's exactly what you said. You're basically lending money to a municipality, a government, a state, a city to do particular projects, and for that they're going to pay you interest, and that interest is typically tax-free if it's in a state municipal authority. So.
And these are bodies that typically can't go into deficits. So where
that's right.
If the federal government, they'd go into a deficit, but a state and a city often can't.
That's right. So they could borrow additional funds. There's many different things they can do, and there are some bonds that are backed by the state itself or the particular city. There are other bonds that are backed in different ways. Some are insured. These are things that you have to look at if you're going to be buying individual municipal bonds. But the idea is that you're going to give them some money, and you're going to get your money back plus interest at hopefully an above average rate.
And some of them are projects. A state or a city wants to build a bridge or a toll system.
Highway.
So you might get a better sense of how you're going to get your money back.
That's right. If it's a highway and it has a toll on it, at least you know that you're going to be paid back by the toll revenue. So those are different ways that you can do it. But absolutely, you should know exactly what you're getting into if you're going to buy an individual bond, because that's exactly the project that you're in. And if it does go bankrupt, then you're going to be out that money.
Generally speaking, though, if I buy an individual bond, I know what my return is going to be. There might be some chance I don't get paid. They're all rated. But if I get paid, I'm going to get a return, a percentage return.
That's right. It's a stated return. You might get interest every 6 months, which doesn't automatically reinvest. There's no way to do that. You're going to take that check and do something else with it. But absolutely, you know what you're going to get and when you're going to get it. The problem now is if you buy a 30-year bond at a low point and rates are higher in 5 years, you're going to be very angry that you locked in at a lower point.
Right.
If we can get higher bond yields coming in a couple of years.
So that is the advantage of buying it in a fund, because a fund manager trades in and out of these things.
That's right. And people don't realize that there is some benefit to trading. There are times when they do things called bond swaps, where there might be a way to do different things by selling one bond and buying another one that boosts the yield. But absolutely, you get bonds that get called on you. And the fund also has the benefit of a monthly dividend that can reinvest for you. So a lot of people like that. It's also a much better and cheaper and easier way to get involved. When you buy an individual municipal bond, people don't realize, unless you have $1 million, you're not an institutional investor. You're paying a price that could be 2 or 3% more, where a fund is going to pool that asset. Or, of course, if you had $1 million, you could get that preferential pricing.
Right.
But that's what the funds are going to hopefully bring to you. But you don't get a fixed return and a fixed your principal back at a particular point.
Kind of, does that defeat the purpose? Because I buy a fund, I buy a bond knowing what I'm getting over time. And you're right, I might have made a bad decision, but I know what I'm getting.
Right.
Now I'm investing in a bond fund, which could lose value or gain value.
It can, and it will. And you mentioned last year and this year that principal value has gone up and down. But I might argue that all last year, while the principal was going down, if you were in a fund and it was reinvesting, you were buying additional shares while it was going down. Now that it rebounded, you had more shares in there. You might have made more money than just hanging on to that individual bond. There are times when you want to buy an individual bond, no matter what type of bond it is. I would say that time is when rates are extremely high and possibly going down. That's when you want to lock in for as long as you can.
Right.
But when rates are possibly going up for the next couple of decades perhaps, and I don't know when, but these are ways that you can sort of roll into that and not commit a whole bunch of money at a particular low point.
Right, and these have all sorts of flavors. So you talked about buying individual bonds, which is not for everybody. You talked about mutual funds. There are even exchange-traded funds for bonds. Now, I know how exchange-traded funds typically work. It's a basket of stocks that you buy. It's got a ticker. You buy it like a stock. How do they work when it comes to municipal bonds?
It's exactly the same way. So an ETF is a mutual fund. It just happens to be one that also trades on the stock market. So you can find municipal bond funds that trade on the exchange, and you can buy them throughout the day. You get into the movement of the particular market on a daily basis throughout the day, instead of just at the end of each day like a traditional mutual fund.
Right.
But you can buy them in an ETF format. Therefore, they might be a little bit cheaper. So oftentimes you can't necessarily
cheaper because there's a lower fee.
A lower
you don't
cost
have an active
internal
manager.
Correct, but you might not be able to reinvest the dividend off of that. So that's a little bit of a difference versus an open-end fund. But there are different ways to do it.
It worries me though, because you need a certain sophistication to understand getting in and out of bonds. So do I give that up by going for an exchange-traded fund versus one where I am paying for a manager, but a manager who's a specialist, one hopes?
There is value in trading bonds if the manager you are choosing knows what they're doing.
Right.
And so if you take an individual municipal bond, you have one bond, you're subject to it. You buy an ETF, it might be a fixed basket that isn't necessarily actively traded. But maybe it's 50 bonds instead of one, but there isn't active trading. And then you'd have a more common traditional fund where the manager hopefully is trading and bringing something of value to the equation for you. So those are different flavors for depending on how you would like to do it.
Let me ask you one last thing. A unit investment trust. What is that?
It's similar to an ETF. It's a basket of securities. Many different firms put that out there, but they have sort of a maturity date. So they might buy a basket of individual municipal bonds. It's cheaper, and it matures at a particular point. You get into what they call spreads, where you might find things at a discount or at a premium. So it's an additional trading level where you can find some additional value if you're buying a bunch of municipal bonds at a particular discount that you can't get in regular mutual funds. So it's another trading vehicle. But all these things should be available to you, and you should research, or an advisor would certainly help you out, and based on what your needs are going to be the best way for you to buy municipal bonds if you need some tax-free income.
Yeah, this is definitely something to study before you get into it fully. Doug Flynn, co-founder at Flynn Zito Capital Management.